Okay, let's dive right into this. If you've ever wanted to start putting your money to work, chances are you've heard these three words thrown around everywhere: stocks, bonds, and ETFs. Now, I know it can feel like this overwhelming alphabet soup of financial jargon, but I promise you, it's actually an incredibly accessible engine for building wealth, once you understand the basic mechanics anyway. Today, we're going to break down these core investing classes so you can navigate the market with absolute confidence. It's kind of the million-dollar question, isn't it? Which one should you actually invest in? Well, here is the absolute truth. Most beginner investors jump right into the market without really understanding the fundamental differences between these assets. And honestly, that is a huge mistake. It leads to bad decisions, taking on way too much unnecessary risk, and ultimately, losing money simply because they invested in something they didn't truly comprehend. We are going to fix that right now. All right, take a deep breath. Here is our roadmap for today's explainer. First, the starting line. Second, stocks. Third, bonds. Fourth, ETFs. And finally, choosing your specific investment path. Let's get into it. Section 1. The investing starting line. Overcoming financial jargon. You know, the market can sometimes feel like a confusing casino, but beneath all the noise, it's really just an engine for wealth. But before we talk about what to buy, we really have to talk about why we buy. The core problem we all face is inflation. Historically, inflation has hovered in the higher single digits recently, sometimes anywhere from 5 to 8%. If your money is just sitting in a regular bank account earning barely anything, it is actively losing its purchasing power over time. Inflation is a silent thief, and investing is literally how you fight back and put your money to work for you. Moving to Section 2, stocks, owning the business. This is the high-risk, high-reward engine. Let's start with the most famous of them all, which historically have generated some of the absolute highest long-term returns. A stock is simply a unit of ownership, also known as equity, in a business. When you buy one single share of Apple, you become a tiny, literal part owner of Apple. Now, sadly, that doesn't mean you get free iPhones, but you do have a claim on a portion of that company's assets and its future earnings. You aren't just buying a ticker symbol. You're buying a piece of a real-world business. So how do you actually make money as a part owner? Well, there are two specific ways. Step 1 is price appreciation. You buy a stock at $50, the company grows, becomes way more valuable, and a year later it's trading at $80. You sell it, boom, you just made a $30 profit per share. Step 2 is dividends. Some large, stable companies, think Coca-Cola or McDonald's, they actually take a portion of their profits and pay it out to shareholders every quarter in cash. It's literally a cash reward just for holding the stock. But as you probably guessed, here is the catch. And it's a big one. Stocks are incredibly volatile. Prices swing up and down every single day based on supply, demand, and honestly, just human emotion. A company can lose money, face a massive scandal, get completely outcompeted by a rival, or even crash to zero. When you own individual stocks, you carry all of that specific company risk. High reward always comes with higher risk. All right, Section 3, bonds, lending for stability. This is your conservative stabilizing force. Let's shift gears entirely here. If the roller coaster of stocks makes you nervous, bonds are a completely different concept. When you buy a bond, you're not buying ownership. You are not a part owner. Instead, you're actually acting as the bank. A bond is just a loan you make to a government or a corporation. In exchange for your money, they promise to pay you regular, fixed interest payments over a set period of time, and then eventually return your original investment when the bond matures. So, the crucial point is understanding this exact contrast. With stocks, you are buying ownership. You get the high volatility and the thrilling potential for explosive compound growth. With bonds, you're lending money. You get predictable income, a much lower risk of losing your initial cash, and a slower, steadier ride. They serve two completely different functions in your financial life. Now, there are a few common flavors of bonds you're going to encounter out there. Government bonds, like U.S. Treasuries, are generally considered the safest because they are backed by the government. Corporate bonds are issued by companies. They offer slightly higher interest rates, but carry a bit more risk if the company goes bankrupt. And municipal bonds are issued by cities to fund local projects. Older investors and retirees frequently rely on these bonds to protect their portfolios and provide steady income, especially when stock markets are crashing. However, the immense stability of bonds definitely comes at a cost. They grow much slower than stocks, In fact, if inflation is running high, the fixed interest you earn from a bond might not even keep up with the rising cost of living, subtly reducing the real purchasing power of your money over time. You are very unlikely to build massive generational wealth relying solely on bonds. Which brings us to Section 4, ETFs, the ultimate basket. Honestly, the best of both worlds for beginners. This brings us to where most beginner and honestly even advanced investors find their absolute sweet spot for long-term wealth building. ETF stands for Exchange Traded Fund. Think of it like the ultimate variety basket. Instead of trying to pick one winning stock, which, as we discussed, is super risky, an ETF bundles hundreds or even thousands of different investments into one single package. You buy one share, and you instantly own a tiny piece of everything inside that basket. So why are ETFs so incredibly powerful? Well, first, instant diversification. If you own an ETF tracking the S&P 500, you own a piece of the 500 largest U.S. companies at once. If one company fails, you aren't ruined because the other 499 are right there to balance it out. Second, they have incredibly low fees compared to older, actively managed mutual funds. And third, they trade easily just like a regular stock all day long. It's a real game changer. Finally, Section 5, choosing your investment path, aligning assets with your risk tolerance. Okay, we've reached the climax of this explainer. You know what these vehicles are, but how do you choose the one that actually matches your specific financial goals? Well, each asset serves a very distinct, structured purpose. Stocks offer explosive growth, but at high risk, perfect for younger investors with a long time horizon. Bonds offer stability and income at low risk, ideal for retirees or conservative savers who just can't afford to lose their capital. And ETFs, they offer that medium risk, passive growth through instant diversification, making them the absolute go-to for beginners wanting the best of both worlds without the stress of picking individual winners. The sources emphasize a brilliant point here. Knowing your risk tolerance helps you invest smarter and sleep better. You've got to be honest with yourself. Are you okay watching your portfolio drop 20% in a bad year if it means bigger gains over a decade? Or would that volatility make you panic and sell at the absolute worst time? Your personal comfort with watching your account balance fluctuate is the absolute key to choosing how you balance stocks, bonds, and ETFs. So, here is the final question you have to answer right now. Are you going to sit back and let inflation silently steal your financial future? Or are you going to take this structured knowledge, open a brokerage account, and start putting your money to work today? The power of compound growth is waiting, but it only works if you take that first, informed step. Thanks for joining me on this explainer, and I hope you feel ready to start building.